Hello and welcome to Stocks Telegraph. Today we're going to be talking about short selling and how it works. Are you ready to learn all? What is short selling and how it works? Let's get started. Short selling is a type of investment strategy that allows investors to profit from decreasing stock prices. It involves borrowing shares of a stock from a broker, selling those shares, and then buying them back at a lower price to make a profit. In other words, you're betting that the stock price will fall. Let's say you believe that the stock price of XYZ company will decrease. You borrow 100 shares of the company from your broker, and sell them on the market for $50 each. That means you receive $5,000 for the sale. A few days later, the stock price of XYZ drops to $40. You buy 100 shares back for $4,000 and return them to your broker. Your profit from the short sale would be $1,000. To start, you will need to borrow shares of a stock from your broker. Your broker will hold the shares in a margin account, and you'll be responsible for returning the borrowed shares at a later date. Once you have the borrowed shares, you'll sell them on the market. You'll receive the proceeds from the sale, which will be deposited into your brokerage account. Finally, you'll need to buy back the shares you borrowed to close your short position. If the stock price has fallen, you'll buy back the shares at a lower price, which will result in a profit. If the stock price has risen, you'll buy back the shares at a higher price, which will result in a loss. Let's say you short 100 shares of XYZ company for $50 each, receiving $5,000 from the sale. A few days later, the stock price rises to $60. To close your short position, you need to buy 100 shares back for $6,000 and return them to your broker. Your loss from the short sale would be $1,000. If the value of your short position falls below a certain level, you'll receive a margin call from your broker, which requires you to add more money to your account. If you can't meet the margin call, your broker will sell your position, which could result in a significant loss. Let's say you short 100 shares of XYZ company for $50 each, and receive $5,000 from the sale. The stock price then rises to $60, and the value of your short position falls below the required level. Your broker issues a margin call, requiring you to add $1,000 to your account. If you can't meet the margin call, your broker will sell your position, and you'll incur a loss. A short squeeze occurs when investors who have shorted a stock start buying it back to cover their positions, causing the stock price to rise. This can result in significant losses for short sellers. Let's say you short 100 shares of XYZ company for $50 each, and receive $5,000 from the sale. Suddenly, the company announces positive earnings, and other investors start buying the stock, driving the price upward. As a result, short sellers start buying back the shares to cover their positions, causing the stock price to rise even further. This is known as a short squeeze, and it can result in significant losses for short sellers. And that's a wrap. We hope you found this video helpful. Stay tuned for more great content from Stocks Telegraph, and as always, happy investing. Please leave a comment to let us know your thoughts, and don't forget to hit the subscribe button to never miss a video. Thanks for tuning in.